to Stock Shots. Our guest today is Diane Swonk, Chief Economist at Mesirow Financial. Diane has been named one of the top forecasters in the country by the Wall Street Journal. She was crowned one of the most influential women in business in Chicago by the Chicago Sun-Times. She has recently been appointed to serve on the Congressional Budget Office's panel of economic advisors, and she is an advisor to the Federal Reserve Board and regional reserve banks. Diane's book, The Passionate Economist, Finding Power and the Humanity Behind the Numbers, is a must-read for the individual investor. Listen in now as I interview Diane Swonk.
Our guest today is Diane Swonk. Diane, thank you for taking time to be with us on Stock Shots.
My pleasure.
Diane, we've heard so much debate lately over the state of the American consumer. Give us your perspectives on whether or not the consumer is about to rebound, or is the consumer really in trouble?
Well, it's not that easy of a question, black and white. The reality is that income inequalities have really widened over the last decade or so after narrowing in the 1990s a bit. And what we have is an increasingly larger amount of consumers feeling left behind, while we still have this stunningly wealthy class of consumers that are growing. So the sense of inequality, it adds up on paper to look better than it feels to the majority of Americans. I think another important point is, the higher energy prices, which disproportionately hit families that are living closer to paycheck, really exacerbates that sense of being left behind. And then you add on top of it that most middle and lower income families, if they do own a house, it is their largest asset that they own. In fact, the majority of households in the U.S., the largest asset that they own is their home, and that's going down. So even if someone who's wealthier, whose home is just more decorative and they can afford a big home, and it doesn't really matter if it's depreciating because they've got other assets that are appreciating, again, that sense of being left behind. The net result is we've seen many trade-offs in spending where consumers are literally moving down the food chain, not eating at family restaurants, eating at fast food enterprises instead because they're still time-strapped. They're shopping at big-box retailers and warehouse clubs to make their food dollar go further, and they're trying to do things to, they're actually changing their entertainment patterns, not going out to the movies as much, watching reality TV, not even renting movies as much as their discretionary budgets are squeezed. So for the moment, tax rebates and the adjustable rate mortgages adjusting down instead of up will help out those consumers and give us sort of a false sense of the read on the health of the U.S. consumer. And my fear is when the tax rebates play out, we will have some give back to this consumer spending right as we come around the holiday season at the end of the year.
Well, we've had several guests that argued that the biggest problem with a tax rebate is going to be that it's going to contribute to inflation. Do you see that? Do you see inflation as a really big problem over the next 18 months?
Well, inflation is clearly an issue at this stage of the game, but the biggest problem with regard to the U.S. consumer and inflation, the tax rebates, is that what we've got going on is the tax rebates are allowing them to spend more on things like gasoline at the pump than they otherwise would. So in that way, it is artificially holding up prices. And the problem will be, again, as we hit the end of the year and those tax rebates are already spent, the problem will be that the consumer will get a double whammy, not having that extra cash in their pocket, and at the same time, they're not going to be able to they're going to be hit with the higher prices at the pump and higher food prices. So, yes, I do think it is an additional problem for inflation. It wouldn't have been as much of a problem if we didn't have these higher energy prices right now.
Well, now, so many people have talked about oil being a potential bubble, that the speculators are driving oil up. I personally think that we just have a global demand story going on in oil. And, yes, it's going to make some pretty volatile gyrations, but I think it's ultimately driven by global demand. Do you think this is a speculator-driven situation with oil?
Well, there's no question that the fear premium on oil and uncertainty premium has gone up in recent years. So whether you want to call that speculation or not, the reality is that oil prices are trading much higher than they were in the past relative to the fundamentals. Whether or not it's a speculative bubble, it's a really tough call. One of the biggest problems in the oil market relative to other commodity markets is how opaque everything is. There's no transparency. We don't know what inventories in China are. We don't know what the Saudis really can produce or what they are producing or what their actual inventories are. There is a lot of noise in the market, and then you have things like the political instability playing out today in Russia, where we're not sure how BP and Russia are going to handle their joint merger, where it's about a quarter of BP's production in Russia, and Russia not necessarily wanting a Brit heading up operations in Russia. I mean, there's a lot of uncertainty in this market, and that uncertainty has clearly buoyed the price. Whether it's speculation or not, I have to say I lean more in the sense that there is a lot baked into these numbers that are beyond fundamentals, so that is a little more speculative. But at the end of the day, you have to ask yourself, is it justifiably so? And some of it is.
Well, we've seen the market, the stock market, go up in the face of higher oil prices, and I'll be honest that with oil at 129, I'm shocked that the market has held in there as well as it has. Is there a point where you see oil really beginning to hammer the market downward if we see oil prices continue to rise? Or is it a spike that would scare you the most, or would it be just continued prices over, say 120?
Well, there's no question that we've hit a tipping point already in terms of consumer behaviors. The Memorial Day weekend, people weren't driving as much. The problem is by the time you realize you've crossed a tipping point, you're already well past it. And so my concern is that we probably have crossed a tipping point, and we're getting a little bit of a false sense of security from everything that I mentioned earlier about tax rebates and things like that, that we're not getting the demand destruction that it's not showing up in the data yet, although it is beginning to occur. And by the time we realize it, we'll have prices even higher and too much out of line, so they'll have to come down more. So this is the nature of the beast, and that's what really is concerning at this stage of the game, is that we are seeing all of a sudden, prices being passed through by the chemical producers. Dow Chemical talking about having to pass through prices now, the spillover inflation starting to take off. Those are things that we were able to avoid for much of the last 5 years as oil prices skyrocketed up. Now it seems that we're not able to avoid them anymore. So I would argue we are at a tipping point, but we won't really know it until we get well into the fourth quarter.
Okay. We've had Peter Schiff come on our show, and he argues that the Fed does not have the tools to combat inflation. Now, we've also talked to Jerry Boyer, who says, I think the Fed has the tools to fight inflation. I just don't know if they have the guts to use it because of what it would do to the stock market. Do you think the Fed has the ability to control inflation?
Well, there's no question they have the ability to control inflation. Ask Volcker about that. The question is at what price? And at this stage of the game, the Fed has been more willing to put growth and financial market stability at the top of their agenda than put inflation at the top of their agenda, although clearly many on the Fed are worried about inflation as well. I think it's important to sort of take some context here. Inflation is rising. It is a problem, but it's nowhere near the problem we saw in the late 1970s and early 1980s. And we're not going to get to that level of it being a problem, but we are in a situation where, if the Fed were to raise Fed funds rate up to 10%, there's no question the Fed could help control inflation. This is just ridiculous to think they couldn't. The question is, do they have the will at this stage of the game? And is it the right bet to make at this stage of the game when everything else is still so precarious? Inflation will likely be more of a problem than it otherwise would be because we are dealing with the financial market crisis we are, because the Fed is concerned about growth. But at the end of the day, will they fight it? Absolutely.
Do you think that now our Fed is more dependent on foreign central banks to help fight inflation than ever before?
Well, the reality is that in a globalized economy, you're only as good as your global counterpart, and there's no question that the Fed's power has diminished over the decades as we become more globalized because we're more susceptible to inflation around the world than we ever were.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.